Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to talk about how you can have a vacation home that is paid for itself. So I used this strategy years ago when I found myself traveling to Cape Cod a lot. I decided to buy a vacation home there. Instead of just having that vacation home be a liability, I decided to convert it into a rental property in a way that it actually not only paid for itself, but made me net income at the end of the day. So this is a great strategy for anyone who has a second home or a vacation home or has somewhere you travel to a lot. You can actually find a way to build an asset and make yourself building more net worth by using this vacation home, second home, whatever it is, converting it into an asset that you're going to monetize. So I'm a big fan of the thought that you should never own liabilities. I don't own my own home because that would be a liability. And I don't ever especially want a second home or a vacation home that is going to be a liability itself. So I'm a big fan of this strategy. This actually is a play on the short-term rental tax loophole strategy that people use for properties that they list on Airbnb or VRBO. But it's a great way that you can turn something that would be a liability into an asset. So to start with, I want to talk about when this strategy makes sense. So it doesn't always make sense for everyone, but I think this strategy makes a lot of sense if you've got somewhere that you travel to a lot. So I was going to Cape Cod several times a year, 3, 4, sometimes more times a year. So I was spending a lot of money traveling there, and it was nice to have a place that I could go to that would be my own, and I could keep some stuff there. I didn't have to keep lugging everything back and forth from the city. It also makes a lot of sense when you have somewhere that you would love to have a house. So if you've just always thought about, boy, it would be great to have a vacation home somewhere, but I don't want a liability. This is a great strategy to use that. You can have that vacation home, but you're monetizing it in a way that it pays for itself. So it's not going to cost you anything extra, to maintain it and keep that home. It's also good for people who, like to have a separate place when they're close to family they visit a lot, especially, if you have family that doesn't have a big house that, is easy and comfortable for everybody to stay in. I know a lot of people who use this strategy to have a home next to their parents or grandparents or just anywhere that they travel to a lot where it's nice to just kind of have your own place to stay. The strategy doesn't make sense necessarily for someone who has a second home that you're going to every weekend, for example. So I know a lot of people live in New York City and they have homes upstate or out on Long Island, and they actually travel to those homes every single weekend. And a lot of times in the summers, they're actually living at those homes instead of in their apartments in the city. So this is probably not a good strategy for that situation. It's really more for if you've got a home that, or somewhere that you like to travel to a lot for vacation. One thing I want to make sure I'm clear about is that when you're thinking about whether these types of strategies make sense for you, you need to think about total cost. So if we go back to my Cape Cod example, I was spending $10,000, $15,000, sometimes more a year on hotels or Airbnbs or places to stay in Cape Cod. So when I'm factoring in the cost that I'm, saving or the extra cost that I'm going to have and whether or not this makes sense and if I'm going to be able to take that home and monetize it in a way it's going to pay for itself, you need to think about the cost that you would be spending to stay somewhere. So if I have, my home in Cape Cod, I actually sold it a few years ago before we had children, but when I had that home, I was saving $10,000, $15,000 at a minimum a year because I could go stay in my own home and I wasn't having to pay any hotel cost or anything like that. So make sure you think about total cost. If you can think about the world that way, especially when you're thinking about investing, that will really set you apart from a lot of people because saving $10,000 to $15,000 a year is an extra benefit to using this strategy, in addition to the fact that you're going to hopefully be getting, a lot of rental income from that property. So the key benefits of this strategy, there's several. The biggest one and the most obvious is that you are creating an asset. If you went out and bought a vacation home and didn't monetize it by renting it out, then you have a liability, and you have a really bad liability because it's not only your personal residence, it's actually a second home. And, that's probably an even worse liability than having, a home that you live in all the time. So you were taking what would be a liability and you were creating an asset. It's an asset that's going to give you two different streams of income. You're going to have rental income from renting that out. And that's probably the best part of this, is that rental income should exceed the expenses that that you're paying to maintain the property. but you're also getting the appreciation in the home. So, to the extent, and this for my Cape Cod home was the biggest upside. I just got lucky with, I was able to time the market right when I sold it because I wasn't under any pressure to sell. So I actually got a huge gain pretty quickly there from that property. Some of that's luck, and some of that's just the flexibility to be able to time markets when you want to. But I was also getting the rental income that was paying for the home itself. So that was great. It's the appreciation is just kind of the icing on the cake at the end of the day. But it's important to understand that you are creating an asset from something that would otherwise be a liability. Also, when you rent that home out, and you're in the business of renting that home, so that's basically, you can kind of think of it as a trade or business, you're going to get a tax deduction for most of your expenses. So this is short-term rentals. We're talking about properties that you're listing on Airbnb. So you're going to go buy that vacation home wherever it is, if it's in Cape Cod, wherever, and then you're going to list that property on Airbnb and VRBO when you're not using it. You want to list it as much as possible. So that is a rental property, assuming that you're renting it most of the time. So you're going to get a tax deduction for most of your expenses. You're not going to get it for all of your expenses because to the extent you use that property, you are going to be required to you're not going to be allowed to deduct 100% because if you're using that property for personal use in most cases, but you're going to get a tax deduction. So interest on the mortgage, property taxes you pay, just utilities, internet, anything that you're paying to maintain that property or to rent it out to renters, you're going to get a tax deduction. You can also get a tax deduction for some of your travel, not all of it, but some of your travel to and from the property in some cases. But it's a great way to convert expenses that would just be, cash outlays into tax deductions. That's going to be, again, most of your expenses. It's not always going to be 100% of your expenses. These tax deductions are also going to be active. So I know with real estate investing, we typically think of that as being a passive activity. So for example, if I have a net loss for tax purposes because of depreciation deductions, then I can't usually take my, loss for real estate investments and offset that against my active income, like my business income or my salary, that I make. But we're using the short-term rental loophole that I'm going to talk more about on the next slide. And that is going to treat these as active in most cases if you satisfy the requirements. So if you have a net loss on your vacation home on your tax return, I'm not talking about a net loss from a profitability standpoint. You should be making a net gain profitability wise, but because of depreciation deductions and accelerated depreciation, like bonus depreciation, then you are probably going to show a net tax loss. You can use this to offset your salary income, your business income. So this is actually a great strategy for W-2 employees. There's not a lot of tax planning you can do as a W-2 full-time employee, but this is a great strategy that a lot of high-income W-2 earners do use. Also, it's not very time intensive. So with other real estate investing strategies, like if you're going to be an active real estate professional, for example, that is actually very time intensive. You have to spend at least 750 hours a year managing those real estate properties. So that is really like a job in and of itself. But the best, or one of the best parts of the short-term rental tax loophole that we're using here is that you don't have to work all that much. You can just list the property on Airbnb. I've done this in the past where I've listed properties on Airbnb and it really doesn't take long. You just respond to messages here and there. I like to have a property manager because I just don't want to be involved in the day-to-day, discussions with people staying there and stuff. But, it's not as time intensive as other strategies involving real estate investing that are great tax planning tools. This one is a lot less requirements of time on your part. So that's what's great about it. Another great benefit of this strategy is that you can make it eligible for what we call 1031 like-kind exchanges. So that allows you to, when you want to go sell, let's say you want to start, selling properties and maybe buying a new property. So let's say, you have your home in Cape Cod, but you decide you've got more kids now, you want a bigger home. So, if you weren't using the 1031 like-kind exchange rules, you would just pay tax on the gain, in the property when you sell it. However, you can use the like-kind exchange rules and actually roll the property you're selling into property 2 for tax purposes so that you're not paying any capital gains tax on that appreciation. So that is a great strategy to use. And you can actually use that indefinitely over time. If you want to just kind of roll up your vacation homes to bigger and better properties, or decide to move somewhere else to, you're sick of going to Cape Cod, now you want to go to California or something all the time, you can use this strategy to avoid paying any tax on the capital gains if you do it right. There are going to be some limits on your personal use of the property a couple years before and after you sell the property. So you do have to be mindful of that. You can't just use it as much as you want. Personally, you do have to, follow the restrictions. So you're going to have to work with a tax attorney or CPA who understands this to do that. But it's a great benefit. The strategy is that you can use 1031 like-kind exchanges. If it was just a pure vacation home or second home that you weren't monetizing as a rental property, it would not be eligible for 1031 like-kind exchange in most cases. But this, making it a rental property, will make it eligible to be, to be able to do a like-kind exchange. So let's talk a little bit more about the actual tax strategy we're using here. This is called the short-term rental loophole. So this is a great tax strategy for anyone who lists properties on Airbnb or VRBO, any properties where you're renting them out, on a weekly or less than weekly basis. This is a great strategy for you. It's a very popular strategy that's come up, with Airbnb getting so popular over the past few years. If you're not aware of the strategy, I'll link below to my video where I talk, more in detail about the rules, the requirements, and how the strategy works. But I just want to be clear that this is this is the strategy we're using from a tax standpoint. We're taking our vacation home, we're going to monetize it by renting it out as a short-term rental, and we're going to qualify for this short-term rental tax loophole. So you can, the great thing about this is with real estate investing, the other good tax strategies, you're going to have to work a ton of time, over 750 hours a year. Here, you don't have to work nearly that much. I like to see people work at least 100 hours a year. It's not completely required. However, I think best practice is you're working, and if you are managing this, you probably are working over 100 hours a year. You can count whatever you're doing, managing the property, messaging with guests on Airbnb, cleaning the house yourself when you're there, decorating, cutting the grass, whatever you're doing that actually goes towards managing that property, you can count to your hours requirement. But, I like to see people spend, at least 100 hours a year as a best practice. You don't have to, you can still qualify if you don't in some cases, but I think that's the best way to do the strategy and the safest way. As I mentioned before, you're going to have to split your expenses. So if I went out and bought a rental property and I never stayed there and it was just pure rental property, I can deduct 100% of the expenses. However, this is a vacation home. We're traveling to it to stay. The whole purpose is that this is a home we want to go stay in. I went and stayed in my Cape Cod home a lot, all the time. So I can't deduct 100% of my expenses. I have to split the expenses between what portion is allocable to, my personal use of the property as opposed to what was allocable to the rental and the renting out of the property. So, again, I'm not going to dive into this in detail. It's just kind of use common sense, however many days you use the property for personal use. And that's just pure personal vacation. That doesn't count necessarily if you're going there to cut the grass and to clean up and, to do work. It's just when you're using the property for your own personal vacation purposes, you're not going to get to deduct that portion of the expenses. So again, you're going to have to work with your CPA on that or keep track of that yourself. If you want to dive into the strategy in more detail, I have an investment tax strategies course that goes through all of the strategies when it comes to investing your money that I recommend looking at and seeing if they make sense for you. And I dive deep into this strategy because this is a great strategy that I think everyone should think about. If it's something that's, anyone in your family is willing to invest the time by listing the properties, I've even seen people do it where their kids are listing the properties and managing the Airbnb because kids are just so tech savvy. And, sometimes they'll do some social media marketing, but, if someone's willing to invest the time to do this and just manage the properties on Airbnb, this is a great strategy. You should consider checking out my course. I dive into it in a bit more detail about the splitting of personal versus rental, rental use of the property. Also, there are documentation requirements, and, you're going to just need to keep receipts as always with any business deduction, or investment deduction, whatever deductions you're claiming on your tax return, you need to have some sort of documentation of that. So just keep those receipts, whatever they are, if it's the phone bill or internet bill that you paid for the rental unit, just make sure you have documentation of that. Also, it's a really good idea to keep a tracker of the time you spend managing the rental as opposed to personal use. So, if you're there cutting the grass, you want to put that on your tracker. If you're there, painting, decorating, whatever you're doing to manage the rental, as opposed to how many days you're there just for vacation purposes. And, that's personal use of the property. So when you take my course, my investment tax strategies course, I'll link to it below. I actually give you a sample tracker that you can use that people find very helpful, that helps them track, all of this. And it's good documentation just in the case that you were ever audited for this. You can just hand over that tracker to the agent and say, look, here's where I was keeping my time. They're going to see you're serious, you know what you're doing, and you kept good records. So they're going to start with the mindset that you probably did a good job with this and satisfied the rules. So again, this is just a great strategy to, monetize something that would be a liability, which is something, you're taking something like a vacation home or a place that you travel to and you spend a lot of money on hotels or whatever it is there. You can actually convert that into an asset, monetize it, and have it pay for itself. I've used a strategy myself. This is a strategy a lot of, very wealthy people do that want to have second homes or vacation homes, but don't like waste. So people like me, that doesn't matter if I could afford it. I just hate owning liabilities if I can avoid it. So I'm a big fan of monetizing, homes when you're not using them in any way possible. And this is just a great way to do that by taking advantage of the short-term rental tax loophole. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.